Now on BBC News, the latest from New York and around the world. Business Today.
Live from New York at the opening bell, this is Business Today. A muted start for Wall Street with a slew of companies set to report earnings and investors unable to shake AI fears. Holding the line, the Bank of England holds rates at 4% as it predicts UK inflation may have peaked. And just keep shipping, Maersk's CEO Vincent Clerc tells the BBC trade remains surprisingly resilient amid trade tensions despite falling freight rates causing the company's stock fall by 5%. Welcome to Business Today, live from New York. I'm Michelle Fleury. We start here in the United States, where markets are reacting to the latest set of jobs figures showing US companies announced the most job cuts in October in over 20 years. That's according to a report by outplacement firm Challenger, Gray and Christmas. Now, job cuts last month reached over 150,000. That's 175% higher than the same month a year ago. And earnings are also back in focus, with a range of companies set to report profit numbers, from Airbnb to Warner Brothers Discovery to ConocoPhillips. Also, what is the price of one man? Tesla investors vote on a pay deal for Elon Musk, which could make him the world's first trillionaire. Lots to cover with our next guest, Sean Clark, Chief Investment Officer at Clark Capital Management Group. Great to see you this morning. Look, let's start with those jobs figures that we got from Challenger and Gray. Obviously, on the face of it, they look very disappointing. Yesterday, we had figures from ADP, which measures private employers. That seemed to paint a more optimistic picture. I mean, where does this leave the Federal Reserve as it's trying to assess where the economy is right now?
Yeah, I mean, this morning's report from Challenger was a big concern. Up until this point, the Fed has been messaging, we agree with them, there's been a gradual cooling in the labor markets. This pretty much might make them turn a little bit of a closer watch on the labor markets as the surge in job cuts in October, and year to date, the largest amount of job cuts since 2020. The gradual cooling has suddenly changed to a more rapid potential deceleration of the labor market.
Sean, so, I mean, in this context, where do we go from here? You've got this growing dissent happening inside the Fed at a time when they're flying blind. I mean, it sort of seems pretty confusing.
Yeah, with a lack of a lot of data out there, given the government shutdown, this should be a data point that grabs their attention. Right now, the Fed funds futures market's currently pricing in just a little bit less than a 70% chance of another rate cut in December. We think this elevates that and should make the Fed, think twice about, Powell's comments about it's not a foregone conclusion that they're going to cut rates in December. This is a data point that I think should cause a little bit of alarm within the Fed and cause them to cut rates again in December.
We will be watching what happens in December. Sean Clark, Chief Investment Officer at Clark Capital Management Group. Thanks for joining us from Philadelphia this morning.
Appreciate it. Thank you.
Now, over in the UK, the Bank of England held interest rates unchanged at 4%. That's diverging from the Fed, which cut again in October. The UK's Governor, Andrew Bailey, sounding a note of cautious optimism, saying that they believe inflation may have peaked. Since August last year, the bank has cut the interest rate 5 times, now on each occasion by 1/4 of a percentage point, falling from a high of 5.25%. But the UK's inflation still remains the highest in the G7. The figure for September was slightly better than expected and is trending downwards. As you can see, at 3.8%, it is still much higher than the bank's 2% target. Well, to help us understand all of this, Michael Saunders is a senior advisor at Oxford Economics. He was also a former Bank of England Monetary Policy Committee external member. The perfect person to help us understand this today. Michael, the bank voted to leave rates unchanged. It was a 5-4 vote. That's a very narrow split. What does that tell you?
It tells us that they're facing a really difficult balance between signs that the economy is sluggish and unemployment is rising, which normally would prompt them to cut interest rates. But inflation, as you said, still well above the target, almost twice the target, actually, which is a reason to keep rates on hold. I think they are likely to cut interest rates further in the next few months, most likely at the December meeting, if not then in the early part of next year. And that'll be driven by signs that inflation is coming down, further signs, and also probably a tight budget, which we'll see in the next few months, which is likely to dampen growth in the next year.
I mean, when you look at the budget, obviously everyone is talking about in the UK whether or not there will be tax increases. Where does that leave the Bank of England? Does it tie its hands in terms of calling the shots on the economy somewhat?
So the Bank of England take the budget decisions when they have been announced by the Chancellor. That's when they take them into account. So at this meeting, there would have been a really strong temptation for them to say, let's just wait and see until we know, which we'll know in 3 weeks from now, what the budget is going to say, and then we can take that into account at our December meeting. If we need to cut interest rates, that would be a much better time to do it, to offset the dampening effects on growth of the likely tax rises in the budget, rather than to have done it now when they don't yet know for certain what the budget contains.
I mean, how do you think the UK is doing? We had that cautious note of optimism from Andrew Bailey, yet, you know, I was in Washington at the IMF only the other week, and they were sort of warning of higher inflation for the UK, certainly compared to some other countries in the Eurozone.
No, the UK has modest growth and quite sticky inflation. I think in the coming year, growth is still going to be pretty subdued. Even though interest rates are coming down, they're not that low. They're still relatively high. And households and businesses are likely to be hit by further tax rises, which will dampen spending. So it's going to be another tricky year for the UK. What the Bank of England is trying to do is, by not cutting interest rates as quickly as the European Central Bank has been able to do, they're still squeezing inflation down. They'll aim to get inflation back to the 2% target. I don't think we'll get back there in the next 6 months or so, but maybe 18, 24 months from now. But it's going to be a long old haul. I'm afraid there's still a bit of pain to come in the economic outlook.
Not the words we want to hear, more pain to come. Michael Saunders, Senior Advisor at Oxford Economics and former Bank of England rate setter, thank you very much for joining us today. Now to trade, which remains surprisingly resilient, according to the boss of the shipping giant Maersk. This in the face of rising geopolitical tensions, conflict and, of course, tariffs. Maersk has raised its outlook after reporting better than expected earnings for the July to September quarter, driven by increased traffic from China. But warnings over falling freight rates are perhaps behind pressure on and putting pressure on the share price, which we should note has dropped some 5% on the news. Here's Maersk CEO Vincent Clerc speaking to the BBC.
What we've seen already since the end of 2023 is the exporting machine from China gaining pace and seeing significant growth across all of its trading regions, really, whether it is Latin America, Middle East, Europe or North America. We've seen that growth. We've seen most growth even into the other Asian countries. So a very, very broad-based growth from China, a market that for the last 8 quarters has kept on surprising by its resilience despite some of the changes, including some of the ones that happened during this year. But this year has been actually a continuation of the trend that was already there in 2024, despite the discussions on tariff.
The boss of Maersk there. Now, in other news, the US Transportation Secretary, Sean Duffy, has warned that air travel capacity will be cut by up to 10% in the US at 40 major airports over the coming days if the government shutdown continues. He said the decision, which is expected to affect domestic flights only, was made because air traffic controllers had been reporting fatigue. The longest in US history, the shutdown is now in its 36th day. And that is all we have time for. But just before we go, a quick reminder, the markets all slightly in the red, pretty much flat, as investors await the latest results from companies. That's it from us. Thanks for watching. Goodbye.